everyone. I'm Mary Beth Melso, and I'm joined with Katie Commons today. And we're both estate planning attorneys at Commons and Commons. And we're here today to talk to you a little bit about gifting because we're recording this around the holidays, and it's a topic that often comes up with clients. But first, before we jump in, I'm going to read a little disclaimer. So this content is for informational purposes only and does not constitute legal advice. You should not act or refrain from acting based on the information provided without getting specific advice from your lawyer. The information herein is subject to change and may become quickly outdated. So, Katie, if you could talk a little bit about the different ways clients can gift and
Yeah. So around this time of year, we often get questions about gifting, and we're not talking about presents, but more like checks. And gifting cash or other assets to members of your family serve a lot of purposes. It's a way of showing appreciation. It's about giving family members opportunities to invest money, perhaps before having to wait until you pass it on through a will or as an inheritance. And it's a way of shifting wealth from older to younger generations for tax purposes. That last reason is especially important for my clients who are above the federal estate tax exemption, and they want to open the tap to get money out of their estate and to other individuals prior to their death. But frankly, it's far more than just those high net worth clients who make annual gifts and want to know about gifting.
So what are some things people should know and think about when considering annual gifts?
The biggest thing to think about is the annual gift tax exclusion, which is a set dollar amount every year. This year, the dollar amount is $18,000. It is going up in 2025 to $19,000. And that is the dollar amount for per donee, per donor, per donee per year. So the amount of money that I could give you, Mary Beth, in 2024 is $18,000, and then that is $19,000 in 2025 for a married couple. So if my spouse and I were giving Mary Beth a gift, we could each give her that amount. So that would be $36,000, for instance, in 2024. And then if I wanted to give an amount to somebody else, say my child, I could give another $18,000, or my spouse and I could give another $36,000 to that person. It can be people you're related to or people you're not related to, but you can see how it can quickly multiply depending on the number of people gifting and the number of people you are gifting to. The annual gift is considered on a calendar basis. So gifts made December 31st, 2024 are in a completely different year than gifts made the next day on January 1st, 2025. It starts over at the beginning of the calendar year.
What if you gift over that maximum exclusion?
So if you gift above the maximum exclusion, it's not the end of the world. You're supposed to file what's called a gift tax return or 709 with the IRS, reporting that gift above the exclusion. But for most gifts that my clients make, no tax is owed with that return. Instead, what happens is that any amount above the exclusion chips away at the federal estate tax exemption that will be available at that client's death. And for most people, that's inconsequential. That exemption right now is really high, $13.61 million per person, and it's about to go up in 2025. So the fact that that is slightly reduced, it's a consequence that doesn't have an actual consequence for most of my clients.
Great. And what about gifting to minors, such as grandchildren?
Gifting to minors, there's lots of options such as UGMA or UTMA accounts, gifting into 529 plans or crummy trusts. These gifts are also subject to the annual exclusion, with a small loophole in that you can give up to 5 years worth of gifts into a 529 plan in 1 year. But you should talk to somebody before you do that. There are some consequences that are important to understand. But yes, gift to minors are also subject to the annual gift tax exclusion.
Are there other ways of gifting that don't count towards the exclusion?
There's a really important gift called really important exemption to this called the Med Ed exclusion, which essentially says that anytime a donor pays directly, and that's important, pays directly for medical or educational expenses, that doesn't count towards the $18,000 or whatever that year's amount is. So again, it's really important that that is made directly to the healthcare or educational institution. But those gifts don't count and can be in addition to the $18,000 that's given directly to a person.
Can gifting get assets out of a person's estate for purposes of Pennsylvania inheritance tax?
Kind of, yes. It's a different thought process than for federal estate tax purposes. So anybody who dies in Pennsylvania is subject to federal inheritance tax, their estate is. But Pennsylvania looks back 1 year and they look for any gifts over $3,000 in the 12 months, not the calendar year, the 12 months prior to the decedent's death. And any gifts above that $3,000 mark are for tax purposes, taxed as if they were still part of the decedent's estate. It stops people from gifting away all their money, maybe in contemplation of their death when they know that they're ill. Any gifts made prior to that 12-month mark, so more than a year before death, it doesn't matter the size, are not counted in that person's estate anymore for Pennsylvania inheritance tax purposes.
And any other warnings you have for people about gifting?
Yes. So the major one is don't gift it if you want it back. Once it's gone, it's gone. But the other thing to keep in mind is that you don't want to gift highly appreciated assets or assets that you think will highly appreciate without considering basis. So if I gift something, let's say I gift my car to Mary Beth, I would be gifting the car's basis also to Mary Beth. And when she went to sell the car, if there had been capital gains, she would owe capital gains on the difference between the basis and the sale price. Now, let's say instead I die with that same asset. Now the basis is whatever that asset was worth on the day that I died. It gets what's called a step up in basis. All this is to say that if you have something highly appreciated that would benefit from that step up in basis, you don't want to gift it away prior to your death. Instead, you want to hold on to it until after your death so that it gets that step up in basis. The higher the basis, the less of a chance that capital gains or large capital gains will have to be paid when the asset is eventually sold. So it's just a matter of choosing which things to gift to somebody. And it might make sense to talk to a lawyer or somebody else who knows about these things prior to deciding which assets you're going to gift, if you're not just writing a check and gifting cash.
Great. Thanks so much, Katie.
Thank you. Have a wonderful holiday. Bye, everybody.